professionally engaging VCM titled Family Office, Trust or Holding, Structure for Asset Management. This topic definitely is a very interesting topic, which I don't think that we've ever covered or spoken about or discussed this topic in Kuwait, at least in Kuwait, that I can say. And we have with us today CA Rajiv Hira, who's an authority over the subject. He is an eminent and versatile speaker whose expanse of expertise, rather, is quite varied. May it be blockchain technology or VAT or management, Rajiv is a high caliber strategic and finance professional. More introduction will come in by Rohit, who will formally introduce him. A couple of updates from the chapter. The existing committee completes the first year of its 3-year tenure in May 2021. And as a chairman, however, I have to vacate my position in the executive committee, and the new chairman would be nominated. So it's a 1-year term for the chairman. So the new chairman gets nominated, and we have scheduled an AGM on 15th of May 2021, which will be followed by a session on health management. Request all members to mark your calendar and make it convenient to attend the event of 15th May. Now, regarding today's session, there's something which I would like to say and hand over to Rohit, is what is the greatest risk to the wealth one manages, a family businesses especially, economic cycles, one would say, or long-term investment horizons one would look at. But I think it seems the greatest risk to the long-term sustainability of wealth by a wide margin is the psycho-social dynamic of the family. And to delve more, learn more on this interesting topic, over to you, Rohit. May I request Rohit to introduce our speaker? And
thanks, Kaiser. Thanks, Kaiser. Yeah, Kaiser has already set a platform. Means already I've introduced Rajiv as a high caliber speaker. So I'll take it forward from there. And thanks for that, Kaiser. And it's an honor for introducing CA Rajiv Hira. CA Rajiv Hira, a high caliber finance professional with an experience of leading roles in private and multinational financial institutions for more than 20 years in the area of technology implementation, process design, risk management, compliance, management consulting, and he is a founder member of RHMC Management Consultants. CA Rajiv Hira is actively engaged in UAE with large corporates, SME, and individuals on process design and implementation. He contributed in development of resources with professional bodies, training institutes, and corporates through structured training, seminars, and articles, having hands-on experience in engaging with regulators and governing bodies in the space of anti-money laundering, counter-terrorism financing, connecting the risk management through system, through technology and interface. So without wasting any time, I'll hand over the floor to CA Rajiv Hira. Over to you, CA Rajiv, and welcome to the session.
Thanks Rohit for a wonderful introduction. So first of all, let me give a thanks to CA Kaiser Sekar. So I think we have heard him talking on a lot of various topics, and his knowledge is immense, and I'm sure chapter is gaining a lot of knowledge on that. My high regards to CA Deepak Bindal also, who's a vice chairman, and he's contributing a lot on developing communication skills is what I have seen from various platforms. CA Shriram and CA Rabindranath. CA Rohit, thank you very much for coordinating and to the last leg and each and every part you are looking at, and other committee members. My immense thanks and gratitude and congratulations to Kuwait chapter for achieving the 2nd position in category 1 from an international award perspective. Hoping for moving to the next ladder very soon, and I'm sure team is working toward that. I need to just mention a couple of few names which gets really inspiring for me when I see them on the WhatsApp groups and the social groups, which is CA Sai. So I saw him on a lot of events, a lot of pictures. He's quite active, and I think he was instrumental in organizing 1st annual conference of chapter in 2019. So great on that part. CA Novel, I met him personally in Dubai with Prabdeep Singh Baweja on a personal basis, and quite inspired to know what's happening at his tenure and and the period. So this happened a couple of years back. And definitely Ritu Sharmaji, whom I just denoted being the person of showing a caliber to a lot of other budding chartered accountants who are coming into the floor. So here is my presentation. I'm just picking it up. Just maybe a thumbs up if you can see the slides now.
Yes, Rajiv, we can see the slides.
Thank you very much, Aditya and Rohit. So I'm going to touch across the family office, trust, or holding company. So first of all, there is a lot of ambiguity on how the holding structure or the trust structure should be working in for any kind of a family office, whether we call it for asset management or a business which is a family business. So these are a lot of debates or conversations keep happening. I ask a question to everyone first to start with. Is there a perfect corporate structure or a holding structure or a trust structure? So you have an answer. I just translate this into, is there a perfect marriage? So answer, we all know there is nothing called perfect in this world, but definitely we cannot only start by when we get married, we don't look at the bride or groom, just saying that, okay, banquet hall is available, cost is less, let me go and marry there. And then I start looking at a bride or a groom. We don't do that. What we do is we find the right partner and we start looking at other things at a later stage. So as a consultant, I have seen so many conversations where people say, Rajiv, tell me the cheapest structure which you have, and we'll go ahead with that. So I think that's the immediate shortcut which we take, and we should not. I'm not saying we should not look at a cost. We should definitely look at a cost. I have my budget for a banquet marriage. I'm going to go to the banquet which gives me effective pricing. But before that, the most important thing is not the banquet, the marriage. So here also we say, first understand what you are intending to do, what is your short-term stroke long-term objective, and then move into whether this is right or wrong. So with the structure discussion, never initiate the discussion with a cost basis. Look at your perspective, short-term stroke long-term. Now I'll connect a lot of things. As Kaiser Saab and Rohit also said, Rajiv is doing a lot of different versatile topics. I always believe if I start from an AML, economic substance regulation, or a value-added tax, or a corporate structuring, these are all very well connected. And we need to connect the dots very effectively to see whether we are going the right direction or not. I have started my practice 4 years back. And since then, I was very clear in my one of the analogy, which I'm going to share you in the next slide, which says that you should have a corporate structure where you can control and where you can monitor. Don't just create a corporate structure in a location which is most cheaper or most economical and then move on. The result, 2019, the economic substance regulation came. I'm sure all must be aware about the economic substance regulation, but I'll just spend maybe a minute or two. So in economic substance regulation, regulators are looking at, do we have a substance in the location where we perform our activity or business, which can be a holding business, which can be any kind of activity or a business which we are performing. Now, if an economic substance is not proved, then there are a lot of challenges which regulators are giving, and there are tax planning which is going completely in a haywire story. Now, what is the structure which we talk about? So as I said, my statement always goes, be in the place where either you have a control is existing or where assets are located. Any of these locations, you should have your base or the place where the structure should be built up. Now, what it stands for, when I say control, where is my board or where are the critical people who are going to take decision in future are going to sitting? Are they sitting in Kuwait, or are they sitting in US, or are they sitting in BVI, or are they sitting in India, whichever location they are sitting in? That's a critical part. And the second part is where your assets are located. I'm not saying assets can be located in only one country. They can be multi-locations also. But at least you should have few assets in the location where you are trying to create a structure. Now, why we say so? We have seen in last few years, as I work with a lot of private banks also from a UAE perspective, when the disputes come, that's where the problem starts. So far, there is no dispute. Any structure you take is perfectly fine. But when the dispute comes, which jurisdiction you will file the legal case is the biggest question which starts up. I'll give you an example where the people have created in Jersey a trust, and BVI is used for creating a company. and that company has a subsidiary in UAE. Now there is a fraud which happened in the UAE structure. Now, which jurisdiction the legal case should go? Because the biggest fraud happened on account of movement of trustee benefits. That means the people who are behind the trust have created some forged documents, and the jurisdiction becomes a biggest issue in those kind of a structure. So we need to always look at how and what jurisdiction can play a role into. Let's move forward. So this is just a starting point. When I say a structure, it can be in any form. There are dozens of structures which are available, and we are going to talk only 2 today. And we are going to see how these structures can help or can ring fence the organization from a holding perspective. Now, I'll start with whether to hold the trust or trust the holding company. So this is where the jargon starts into what is the best method of having the structures into the organization. But before that, let's quickly wrap up what is the holding company and what is a trust, and how we can marry both. Maybe if we may require both the structures to put up the benefit which an organization or a family office is going to look at. Now, before defining any holding company, I will say, jot down some of the points which are you going to held up. Now, these are very specific points which we talk about. We are talking about how many number of locations we have. What is the asset protection you are looking at? Are we looking at the in-house asset protection, or from the banks also, or from the creditors also? What is the liability protection you are looking at? Had we given some personal guarantees, or are we giving our company assets or the guarantees from the organization, that is a corporate guarantees, to work into? What is the business model we are talking about? Is the business model a passive company or an active company? When I say passive company, we are talking about the company which only earns the passive income in form of maybe rent, royalty, or any kind of a structure where you are not actively involved and the income is earning, which can be dividend or interest income also. Or we are into an active business model. So these both can also differentiate the model or the structure which you are going to have it. There may be activities with only certain percentage of ownership can be taken. How to protect yourself in those cases? I know in the Middle East, there are businesses where 100% owner has to be a national. An expat cannot hold that ownership. There are certain type of business where only 51% or the majority shareholder has to be a national. It cannot be any other person. So these are all critical points which need to be articulated, need to be analyzed before we create any kind of a structure for the organization. So this is where the holding company theory or a holding company definition comes into play. And as I said, the passive holding company, which we talked about, a holding company that owns shares, investment of other company. A passive holding company does not produce goods or services itself. So this is the most important thing which we talk about. Just to connect here on economic substance regulation, when we have a passive holding company, the organizations have to prove lesser substance than the active holding company. So if I have a passive holding company, what I do is, I think, Rohit, if you can mute yourself. Yeah, perfect. So I think someone's, okay. So as we said, the passive holding company is where you are only holding the shares and the income is only in form of dividend, interest, or royalties. So these kind of incomes which are coming up, these are majorly a passive holding company, and economic substance gives quite a leverage. And they say that it's okay. You don't need a substance to prove on account of offices. You don't have to prove substance on account of employees. However, show us where the decision making is done. That means when I'm doing investment in a company, how the decisions are done and which place these decisions are done. This becomes very important for all jurisdictions. I'm sure everyone knows, like from an India perspective also, I keep connecting India also because a lot of time we have connects from an India side. India has a very stringent law on the POEM, place of effective management. And the similar provisions are there in the economic substance. If your place of effective management is not the country where the holding company exists, maybe the taxation rules differs to us. Maybe the non-resident Indians who are having a company which is being controlled from India, which get taxed. So that's also important. So you can see, we are just connected right now, the holding structure with the taxation and with the economic substance. So they are all connected. If we just think that we are going to talk about only separate on the holding structure. I think that's the biggest mistake which we'll do. We have to combine all the action plans, all the decisions which are there to move it on. Now let's look at the broad or a typical holding structure, which we see here is we have a shareholder 1, we have a shareholder 2, we have a shareholder 3. So number of shareholders which are there, they have a shareholding in a company, and that company invests in either construction company or manufacturing company or proprietary investment we talk about, or any kind of a property investment here we are talking about, which is again a kind of a proprietary nature, or offshore companies. So these are all structures which we use for a holding company. Simple, very, very effectively done. But what happens, imagine if shareholder 1 says, I want to exit. Now, this is a family office. You have 10 family members or 5 family members, and all these family members came together. And what the father or the head of the family said, let me distribute the company and give shareholding to everyone. Perfectly fine. So everyone got their share of what they're supposed to get as part of ancestral property. They got it when the owner or the head of the family is living. Everyone got their shares. What happens if the shareholder 1 says, I want to exit? The whole business will come into a question mark. That means if a shareholder 1 agrees to go to a competition because he's getting a better pricing, because of conflict in the family, because of conflict in whatever thoughts we talk about, or he's getting a simple pricing. He's not interested in what's happening to the family business. He's interested, I'm getting my better price. Let me take it and move on. So that's perfectly fine. But imagine one shareholder can create a threat to all the shareholders in that business, because your control may get reduced, or you may get an influence from a competitor, which may not be able to add up value, but may reduce the value from a business model perspective also. So there are various things which we look at. And these are things which we talk about when we create a holding structure. Ensure there are some pointers being added in the shareholder agreement. And what are those shareholder agreement pointers is what we are going to look at. Now, this is what we said. If one of the family member wants to encash his or her share in the open market by selling, the whole holding company or the family office comes into a question mark. We say add up at least minimum these 2 points. One is right to refusal. So these are the agreements which are getting drafted between the shareholders. Now it is crucial to include the first right of refusal clause in your shareholder agreement. That means if I'm selling shares as a shareholder, I need to first offer to the existing shareholders. If they refuse, then only I can go out in the market and sell the shares. It's a very small part, but a very important, because if family has money or the other shareholders has money, they can buy the shares and they say, okay, fine, you sell shares to us and move on, which is perfectly fine. And the second clause, now there are times when the shareholders may not have that money because they've invested everything in the business. So whatever they are doing is part of the business. They need to add one more clause, which we say is tag along rights. That means if I am going and selling outside at a price, which may be a higher price, other shareholders can also tag along with him or her and say, you have to sell these shares. Proportionate method, there is a ratio method. So all those things can come into. So tag along right, also referred to as co-sale right, are contractual obligation. If a shareholder sells his stake, it gives the right to other shareholders to join the transaction and sell their stake in the company. Now, these are interesting points, but technically speaking, if you see, in both these points, you are putting risk to the business. One, in the first case, the shareholders are going completely cash out. Maybe they will not be able to have more money to put up for the expansion plans which they thought for, because they have purchased the stake from other people. Or when you tag along, you're technically diluting the shares. Either you yourself do or other people are doing. The dilution of shares are happening. And there are quite a heavy amount of risk which we have seen in the family offices in these structures. Now, these are few pointers which we are talking about. Now, why these pointers will arise? Because in this case, the head of the family has already given the ownership to the family members in the beginning itself. That means you're given them right of income and you're given them right of assets. at the first stage. So this is where the challenge comes into. How can we ring fence that challenge? Again, in this case, we say bring up something on the trust side. Now, how? I'm not saying that holding is not right or trust is not right or trust is the only solution. No. What we are saying is we need to see the objectives. We need to see the plus and minus of both the structures and bring up together, so that when we have a conversation or when we do a discussion in a right forum, we know which direction we are getting in. Now, trust word itself says trust. So this has a lot of characters which comes into the play. I'm sure as a learned professionals, we all know this, but to bring everyone on the same boat, I thought, let me give a quick definition of these elements also. So typically we talk about 4 terminologies or characters in this. One is a settler. Second comes as a trustee or a protector. So we are going to look at the difference between trustee and protector also. And the beneficiary. And the last comes the corpus. That means the trust property. Now this trust property can be in form of physical assets, which can be a physical property. It can be in form of shares, which is being invested in other companies. It can be a wealth, which is being invested in other private banks or whatever structures we have invested the money. So these are 4 elements which are very important to understand and look at what are the roles and responsibilities of each character which we are talking about. Now, the settler, you can see the big pot of money in the hand of the person. So this is where the settler does. Settler says, I am bringing up all the money and I'm establishing a trust. Now, settler can be denoted by other names. There are various names which we use. We say them donor, guarantor, truster, or trust maker. So it can be any name which we talk about. So, but the main objective, what he is doing or she's doing is bringing all the wealth together. And they're saying, I'm settling the trust or the funds in one structure. So what we say is, regardless of whatever name, its role is to legally transfer control of assets to the trustee. Now here, the trustees are coming into the picture. Who manages it for one or more beneficiaries? In certain type of trust, that settler may also be the beneficiary, the trustee, or both. Now there are various forms of trust which comes into, which also we are going to talk about, how you can ring fence when you put all your money in a trust and say that I have a trustees who will going to manage this business for me. Now in a corporate parlance, if I say, trustees are nothing more than the board of directors, which we appoint in the corporate world. So they don't have ownership of shares, but they manage the business. So that's where comes into. So a trustee is a person or a firm that holds or invested property or assets for the benefit of third party. Now, trustees are not beneficiaries. They can be beneficiaries also in some cases, but very rare, because if you have a trustee who's a beneficiary, the vested interest may come. So it's always good to appoint a trustee, which is a third party. Normally, a lot of private banks, a lot of legal organizations give their professional services, and even from the family members also, you can create a trustees. Trustees are trusted to make decision in the beneficiary benefit interest and often have a fiduciary responsibility. Now here, it's not that trustee can do anything. If they have taken decision which is not being documented as part of the trust document, which are the bylaws or the act in which the trustees can perform, then there is a fiduciary responsibility also comes to the trustee. So trustee can be held responsible if something goes wrong very clearly. We need to look at how these trust duties are being deployed and who are the people whom we are appointing as a trustee. Now there is a small difference which comes between a protector and trustee. Normally what we say is a protector is over and above the trustees. That means trustee are holding the assets, whereas protector is a person who is guiding the trustees in some cases. So in this case, the trust protector can be an individual or a group of individuals. So you can say, in my family, I have my uncle, my nephew, my niece, whomsoever who is not part of the beneficiary. You create those people to sit together and create a protector kind of a atmosphere. So they become the caretaker under the umbrella of trustee. So trustee will hold the assets physically, whereas the protector will guide them how the decisions has to be taken, when the dividend has to be given, when the assets has to be sold or purchased, or what need to be done. Now these are all which we talked about from a trust perspective. Now again, the other thing comes is who are the beneficiary. Now, the beneficiary story can be very different when we talk about. We can say now in the beneficiary side, there can be a two-part. One, a beneficiary with the assets also. And second, the beneficiary only for the income. So I've created in my family office, I have created a trust. In that trust, I say I have assets worth $100 million. However, not a single asset value can be benefited or can be taken by anyone. But what they can do is every year, whatever income is earned can be distributed to all the people. So you are creating a beneficial interest in a various forms and fashion what you want to do. And why we do that, I'll come back on those, some of the pointers which are very important. When we create a trust, how we can ring fence all those aspects. Now, in this case, a beneficiary is any person who gains an advantage or a profit from something. In the financial world, what we say a beneficiary typically refers to someone eligible to receive distribution from a trust, will, or life insurance policy. All these are part of a trust assets, which we talk about. Now, beneficiaries are either named specifically in these documents or have met the stipulations that make them eligible to whatever distribution is specified. Now, I have a choice. I can name the beneficiaries in the document, or I can give that authority to the trustees to define whenever the beneficiary or whoever the beneficiary is at a later stage. Now, when I define those elements that I don't want to name the beneficiaries, if something goes wrong to the settler also, the money or the assets cannot go to the beneficiary in the one go. It has to follow to the principle, to the process in which it goes into. Now, last thing comes on the terminology side is a trust corpus. This is the amount which is being set aside in the trust, and the trust people are going to look at it, how this wealth is going to be distributed. So these we have done the jargon side. Now, why trust has to be looked at rather than the holding company, which we talked about in the first go. So when we talk about a holding company, we said at the day one itself, equivalent of settler gives the shareholders to shareholding to all the beneficiaries, right? But in trust case, we are saying, no, hold on. You're not giving the rights to the shareholders, but what you do is, these are the pointers which come as why we are creating a trust and what will help and why it will help us to creation of trust. So first thing first, if an individual is holding an asset, it's a very simple way. People can say, create a will, and whenever something happens wrong to the head of the family, the money or the assets can be transferred. Yes, easily said and done, but there is a long process of transferring the assets when something goes wrong to the head of the family. The process starts, as I have written only 5 steps, and to be honest, these 5 steps can be broken into 50 steps. One step is authenticating the last will, whether the will which we are acting is actually the last will, or this is the second last will which was written. You know, will can be written anytime, and based on will, the asset transfer has to happen. So if I've written a will 1 month back, and yesterday night I felt something different about one of the beneficiary, I changed the will. Whether the will which is in hand of the legal people is the last will or not becomes a very difficult question. So there are jurisdictions where registration of will is mandatory, and the last registered will is considered as the authentic document. But we have to go through the legal system to take out the last will. Once you have a will, you need to look at who are the claims or who people are there to collect the money out of the person who is no more there. So you have to collect claims from creditors on assets. You have to locate the assets where the assets are located. A lot of times wills have the point, but they don't have information how the assets has to be diverted or how the assets has to be differentiated and distributed. Then comes determine the value of assets. So how you will define what is the value of assets. Then comes again a story. If you have assets, let's say in US, UK, Europe market, how you prepare on the taxation front. Because you need to take care of the taxation also, because the change of hands are happening. Who is going to take care of taxation? Even in India also, if the assets are there, there can be a gift tax or a wealth tax which will come up. Then comes the last point, which is distribution of estate or assets. Now, what happens in this whole process? Till the time this distribution of assets does not happen, generally in maximum countries, the accounts or the assets get frozen. That means no one is able to use that assets for that period of time. Imagine this thing happening for a large family office where ownership is held by a single person. So that's very critical, because your your administrative process completely stops. It drops out. And unless and until you don't get court orders, which only comes up as part of a settler or as part of a people who are settling their assets. So this becomes a critical part on the how the will and why the will should be created by each and every person who has a substantial assets, and definitely when you're working on a multi-jurisdiction location. So when you're working on a multi-jurisdiction location, it becomes much more important to see these assets are being ring-fenced. Now there is a very interesting thing which I have seen. You remember MH370 case, so where the flight was missing, and still the traces are not there. There are a lot of stories, but there is the traces of assets of people are not there. So what if person is missing? He's not dead. You can't go to the will story itself. Every country has a period. Unless and until that period does not lapse, you can't qualify that person to be dead because the person is still missing. Or what happens to the financial consequences? For family, it can be completely devastating, and people will not be able to use a single piece of asset because the person is not declared dead. So you cannot execute the will. You cannot create a probate. So what we talked in the previous slide. So that means before even we start looking at whether the will is there or the asset has to be distributed, you need to prove, or you need to sit with some time, which is a bona fide time. In some cases, it is 3 years. In some cases, it is even 10 years also. Unless until that is proven, the assets cannot be transferred. Now, what happens during that 10-year period or a 3-year period or even 1-year period? How the beneficiaries are going to get the benefit, or how the beneficiaries are going to survive in their world? Forget about benefit. Because right now we're talking about a survival story also. So MH370 has raised a lot of alarms to, and these are not people who are hand to mouth. There were people who were really having good amount of wealth, and the families were not able to utilize a single penny, although money is there in the bank accounts, although investments are there very clearly articulated, but they were not able to utilize those assets. So these are some of the reasons also which is becoming an important part, how and why the trust side should be looked at if the assets are held by a single person who is head of the family. Now, one more thing which we have seen where beneficiary who may be minor or may not have ability to use the funds wisely. So we have seen where there are brothers, sisters, or whomsoever, and one of the person does not have the right intent or a right company to look at it. So you can see the gambling. If the wealth or the shares are being transferred immediately or to the beneficiary, I don't think so. He or she may be able to utilize that assets very effectively. There are chances they will lose the wealth of themselves and maybe for others beneficiaries also. So we need to look at how we can protect the beneficiaries who may be minor. So minor may not be able to take decision. That means you need some uncle, aunt, or some relationship who can look at how these assets can be protected. So this is now people have dreams, and we have seen people want to live that dream even if they leave the world. So as a businessman, someone has created a very nice business. He has a vision, he has a strategy, has executed it, and is in a success model right now. And business is running very fine. However, this is a closely held business. That means one business. Let's look at the old story of Reliance, if we can relate into. So Dhirubhai has created a business model and which got broken into various versions. Although one of the person has gone to a right direction and one of the person has lost the wealth. So what kind of a vision Mr. Ambani had in his previous, when he was alive, has completely gone into a different direction. So business owners may have a clear strategy for the business to be working with complete governance and employees without intending to disadvantage the surviving dependents. Now in this case, they have created an empire which is run by professionals. They don't have a problem, but they want their dependents to also get the benefit, but not the assets in their hand. So there are trusts which are created where none of the assets can be liquidated. That means you cannot sell the assets for the benefit of beneficiaries, but lifelong, they can earn the dividend. They can earn the income from those assets. So this is also one of the interesting things which we have seen, which is coming up, especially for the large business houses, where they understand now we are running a business not as a personal business or a personal empire. We are running a business as a corporate structure. I have a very clear governance place we have a very clear place for even family members also to sit in the board and define the governance structure, but they don't have a control in selling the assets. So you ring fence in such a way that the beneficiaries get every month or every year their respective share of profit. However, the assets cannot be. They don't have any rights to sell the assets in near future. Or maybe you can write a condition that after 10 years this can be done, or after 20 years this can be done, or next generation can do it. Or you can put a condition, if the asset goes beyond $100 million, then whatever is additional wealth can be distributed as a wealth. Otherwise, it can only be a profit. So there are a lot of conditions which comes and plays in the important part, as we said, when we write the bylaws of or a charter of the will. These are all conditions which the settler can define. Settler is available right now, or settler is no more. Both these conditions can be looked at, where one, you transfer the assets, or you don't want to transfer the assets. You transfer the profit, or even you don't want to transfer the profits for a fixed period of time. So these are quite interesting things which we have seen. And there is a very superstructure which comes is where you want to consolidate the assets and you want to create a corporate act. Now here also the trust plays an important role. Example, imagine as an individual, Kaiser Saab holds 500 assets and these are all held in various countries. Now it's very difficult to Kaiser Saab to look at how they can travel to X country to sign the documents or Y country to sign the documents. So when you create a structure like a trust, you are creating a corporate will. And in the corporate will, you can always have a power of attorneys which are given to the board equivalent people, because the asset size is so huge, it's so fragmented, and it's in the multi-location also. It becomes a very important part to see how this corporate will can be looked at in a trust structure itself. I'm not getting into right now a holding structure. I'm saying within the trust itself, you can create a corporate will, you can create a head of the trust, and which can be a protector, and there is a trustee who are managing the assets. So you have created a document which clearly articulates, as I said, from a trust document perspective, which can be part of bylaw or charter, and you differentiate what can be done, who has a right to play on the assets, who has a right to see how the consolidation can be done, how the business model can work, and who are the decision makers in this process. So this is a model which we have seen, especially in Middle East now, coming up very effectively, where people who are from our larger families are looking at how they can consolidate their assets. And not only trust, I will give you a perspective how they use it right now. It's a mix and match of trust and holding company, which creates a very effective model for a corporate structure perspective. Now, these are things which we talked about how the trust comes into. Now, there is one more thing which is very important. We have seen there are trusts which are discretionary trust, and there are trusts which are non-discretionary trust. Now, discretionary means still the discretion is there with the trustees. You have not transferred the discretion to, and you're not written the name of the beneficiaries. Now, discretion can also be by the name, but not percentage. Example, I have 5 family members. I have written the beneficiary names A, B, C, D, E. Now, within these 5 beneficiary names, assets can only be transferred to these 5 people that I have defined. But I have never defined what percentage can go to which person. So this is again a part of a discretionary trust. And there are reasons why we do this. And in this case, if you see the last line which says, in this case, they may have access to income, but no access to assets. Because the access to assets is purely with trustees right now. So a discretionary trust is basically a trust that has been set up for benefit of one or more beneficiaries. It can be named beneficiaries or not named beneficiaries. Perfectly fine. But the trustee is given a full discretion as to when and what funds are going to the beneficiaries. The beneficiary of trust has no right to the fund, nor the funds regarded as part of beneficiary's estate. Now, why we do these kind of a trust structure? One of the examples which we talked about, if the beneficiary is minor or the beneficiary is rogue, that means you never know what's happening. One more example, which I'm seeing this very appropriately, which is coming up from Nigeria clients or Africa clients continent, where they say, I have a young son and I'm marrying that son. What happens if the girl asks for separation after a year and puts a condition that give me estate money also? So when I'm creating a discretionary trust, the money never goes to the son, and hence the daughter-in-law cannot have any condition of collecting that money in any court of the law. It can happen to son-in-law, it can happen to daughter-in-law. So I am not getting into one direction. It can happen to either sides. Whichever law or whichever country we look at where these conditions are applying. People are very scared because the marriages are sometimes, I'm not saying always, people are looking at only the wealth and see how we can grab the money and move on the relationship at a very short span. This is the fact of life. We agree, we don't agree, but that's also is happening nowadays. And a lot of HNIs, we have seen that conversation. They're openly talking on this conversation. They say, I want to ring fence my estate before the marriage of my son or my daughter happens. So this is where, now when we say a discretionary trust, the trustee of discretionary trust has complete control over the fund and is generally regarded as a legal owner. Now we keep talking about beneficial owners here. Now imagine there is a settler who has settled the fund with the discretion. That means till the time settler is alive, he can change the beneficiaries at his will anytime. So that means the person who is settling the money has a right till the time he is in the world, how to change the percentage of benefit which people are going to arrive at and take the benefit from someone or give additional benefit. Both things can be done. On his, when he's no more in the world, he has given that discretion to the trustees. Now the trustees cannot take money because trustees are only having the fiduciary capacity. They are only acting as a trustees. They don't have a right to utilize the money or take into the bank account or anything. They have only right to manage the funds. Now in this case, I'm creating a condition that every year distribute whatever profit comes, maybe 30% or 40% of the profit, and balance you keep adding to the corpus. So I've created a condition in such a way that the money cannot go out. The benefit cannot be taken out on account of regular income for the beneficiaries which I have. However, I'm not giving them legal control also. I'm not giving them the control of the assets. So none of the conditions we talked about where the owner can sell the shares and move out is possible in this kind of a condition. Now, which we talked about, where to use discretionary trust. Two conditions very clearly you can look at. One, where you are entering into a son or a daughter's marriage, and you can see, I don't want to give a discretionary trust right now. I want to use discretionary trust basically. I don't want to name the beneficiaries because I don't want the benefits to flow out or from the wealth of the family till the time relationship is settled. And the second condition we talked about, whether you have a beneficiary or you don't trust the act of the beneficiary because you may feel that he or she may spend the money in a very wrong direction or a wrong side, and you may not have a confidence to start with. So these are one of the things which we always say, look at the condition. Now, as we talked about, what is important in structure? So structure is coming back. You need to look at your family. You need to look at your core structure or your family office or people whom you are associated with. Are they aligned to take care of the wealth which you are handing over to them, or they are going to just spoil the wealth and spoil their future also? It's not you are holding the money for yourself. You want to distribute as a settler, but you want to distribute with a discretion. So that's an important part which is very, very critical when we look at from a trust perspective. Now there is a non-discretionary trust, which is pure a magic lamp. Whatever the person has written as a settler, he has written the names, 5 family members. Whenever something happens to me, distribute everyone 20% or whatever ratio you want to define. And the trustees are going to just follow that. So this is also a risky model because sometimes what happens, a collective industry of $100 million is worth $100 million. But the moment you break that industry into 20%, maybe your wealth itself will drop down to $20 or $30 million. We have seen that situations when you have a business, large empire, and when you break a large empire, the wealth and the value of the benefit also goes off. But yes, you can create a non-discretionary trust where assets are differentiated. Example, I have an asset, which is a hotel asset, which is separate. I have a manufacturing company, which is separate. I have a different businesses which are separate. I can say, whenever something happens to me, this business goes to Mr. A, this business goes to Mr. B, this business goes to Mr. C. And I'm creating a very clear structure where assets are distributed and even future wealth is distributed. Now, in this case, the moment you write beneficiaries as a non-discretionary trust, till the time settler is there, normally we have seen settler does not leave that discretion because he's alive. You want to take a control of assets, but name the beneficiary. So whenever something happens, the assets gets transferred to the beneficiary. The moment something happens to the settler, by default, the beneficial interest gets activated and the trustee has to transfer the assets, definitely by taking care of what are the liabilities which are there against assets, so that the assets are also settled. The liabilities are also settled before the assets are transferred. So this is what we say is a magic lamp. Whatever the ACA has said, the trustees are going to follow that. There is no thought process they apply on that. Now, how can we use a trust and holding company to plan? So this is what we talked so far. We have talked what is holding company, we talked what is trust, and what are the benefits of trust. I always say, don't follow one principle, follow both principles and see how we can marry both. What can we do to combine both the structures for the benefit of everything and anything? Let me give a model here. So what I did here is I created a settler who has created a trust. Now this trust, the golden colors which you see is a part of a trust. And below the trust, I have created a holding company. Now why I'm getting into the holding company structure also, I will tell you. Now I have beneficiaries. I don't have shareholders. I have a beneficiary 1, 2, and 3. And just take a condition that we are creating a discretionary trust. That means everything held with the trust, all the controls of assets or shareholder are sitting in the trust itself. They are not sitting in the holding company. Whereas when the beneficiaries are there in 1, 2, and 3, they can be part of the governance. They are part of the board of directors. They are part of the controlling people, but they don't have any rights to sell the assets. They can do expansion. They can utilize the profits which are getting into, but they don't have right to sell the assets. Whenever the condition of selling comes into, it will go to the trust for taking decisions. So you are creating a corporate wheel in this case, and you have differentiated the ownership structure. The benefit, now in this case, imagine if something happens to the trustee, to the settler in this case, and the trust agreement has to be executed. Point number 1, by default, on this demise of the settler, if the condition is saying that way, it's a non-discretionary trust. On demise of settler, beneficiary 1, 2, and 3 will automatically become shareholders and they start controlling the companies which are there. That's a first condition I'm giving. The second condition I'm giving, if I don't want these assets to be broken or bifurcated, I can put a condition that this is a discretionary trust. And whenever something happens to the settler also, the protector will come into the picture and he will take care how the assets has to be looked at. Imagine, protector cannot take the money. Protector does not have a control. He's not a managing director. He's only managing the show. Whereas the trustees are pure trustees of the assets. So you have created 2 layers. 1 who is protecting, 2 who is managing. And beneficiaries are getting the benefit through the governance process. Because you can always define in a larger organization, we have seen, they give 50% board rights to the beneficiaries and 50% are executive directors. So that means you're creating a place. I'm talking about a larger organization, maybe more than 1 billion value of assets. You're creating a space where beneficiaries are also getting benefited. However, they have a control in the running of business, but they don't have a control on the asset of the business. They can always get profits, and profits, I'm not saying 100% profit. Generally, we have seen 40 to 50% of profit gets distributed and 40 to 50% profit gets added up to the corpus of the trust, which keeps on increasing in a very interesting way. In case of dilution of asset, of trust, it will not impact on business or holding structure. Now, if you see if something is happening on the trust side, what is changing is only the shareholding. Whereas my holding structure, which is all below, will keep on running as a corporate structure and there is no change which is happening. It's a purely professional run organizations and you will not have a a stopper if something happens to the settlor or even beneficiary changes, because you already have a conditions which are sitting with trustees to take care of the change in the will. Now, there is something interesting happening in various jurisdictions. I have one example which I'm going to show you, where they have created a trust which automatically takes a corporate structure itself. So you don't need to even have a holding company. You can create a trust, and the trust has a corporate will. That means we just can just change the nomenclature. Instead of board of directors, you have trustees. Instead of managing director, you have a protector. And instead of the corporate holding which is coming up, everything is intact. And whenever the trust gets diluted, I will say, or the settlor is no more, automatically the beneficiary will become a shareholder, and the same entity will be converted from a trust structure to a holding structure. So this is where I'm giving one example to you. There are various jurisdictions which are adopting this principle, but Abu Dhabi Global Market, which is part of a UAE, and I've seen a lot of Kuwait family offices, they're creating holding structures within Abu Dhabi because of various reasons which are there. Benefits, I will give you a perspective on this. This is a structure which is working on English common law. They have adopted. So there are few jurisdictions. What they have done is they have picked up English common law and translated or adopted section by section, and they translated into their own document. Whereas what Abu Dhabi market has done, they have picked up the law. They said whatever is changing in the law from English common law perspective, that changes same time accepted and adopted in Abu Dhabi. So they have their own courts, which are very, very effective courts from arbitration perspective, which is working. And I'll give you some broad pointers which Abu Dhabi Global Market is offering on trust. What they call here in the, they don't use the word trust, they say foundation regime. So ADGM foundation regime, you can easily go and look at from an ADGM perspective. That's a structure which is there. Just giving a quick snapshot of what are the benefits which are coming up. So now there are various things which they are using for giving a corporate will. A new type of legal entity is what we talked about. A foundation operates like a common law trust, yet has feature for more similar to company. They have a very robust governance process. ADGM is one of the refined, I will say, regulatory system or regulatory body which is working in the region. They have a distinct legal personality, which is what we talked about. So when you go to open the account or something like that, you already have a certificate of incorporation. You have the trust deeds, which is authenticated, the trust deed, which is registered, and you can use those documents very effectively in the court of law and in the documentation which comes into play. Now, coming back to my story on how the structures are impacted in various portions or various pockets, which we talked about. So if you look at how the custom law is there, how the economic substance regulation, how the banks are looking at, even taxation, which is going to come up in Kuwait very soon, and CBCR, country by country reporting, or we say how the regulator, excise, common reporting standards, or tax authorities, whichever name we call, they are looking at structures. They are looking at how the beneficiaries are being identified and picked up from there. Times have gone where you can hide the owners behind the company or behind the trust. That's not the case now. Whatever layers you create, people are, and the regulators are asking for, show me the warm bodies, which are part of the structure. Show me the organization or show me the people who are behind the structure. So whenever these organizations comes into, you have to very clearly bring up those discussion points and see the structures are being very clearly defined and articulated into. So is there a perfect corporate structure? Again, I'm coming back to the question to the people. I think there is nothing called a common perfect corporate structure. We need to always evolve into what is best for the organization and what is best for the people to look at. So any questions which are coming up, let's pick up from there, and I have a few more points to talk about, which I will do. Yeah, Rohit, you want to pick up the questions from the live audience?
Yes, sure. Yeah, if anybody have any question, you can post your questions on the chat window. So we'll take it up from there.
Even we can do a live discussion also, I think.
Yeah.
Chandrasekhar ji is saying, could you please tell us your views on Sharia law and these trust structures? Perfectly fine. Chandrasekhar ji, I was expecting this. Let's go back. So just to give you a perspective from ADGM perspective, they considered the Sharia law principle also, and they are compliant from a Sharia law and look at the structure which is very effective and is in compliance to the Sharia law also. The ADGM I'm talking about is it's applicable. How the Indian income tax on trust model? See, whenever you look at from an India perspective, trust itself is a legal entity. So George, from India perspective, if you are having a trust in India, or what are you talking about? You have assets in India and trust outside, or what is the connect from an Indian income tax perspective? What are you looking at? Maybe George, if you want, you can come on the live discussion also. We can look at your whole perspective. Assets in India. Okay. Now assets in India, go back to the Vodafone case. Very interesting. Wherever your structure is, if your assets are in India, you are done, and you have to look at the asset capital gain or whatever it's happening will happen from an Indian income tax perspective. That's the reason, if you remember, we have talked about when we create a trust or even a will also, the transfer of assets always creates an asset obligation, which is a point number 4 which comes into. So we have seen it very effectively whenever, like Vodafone case was a very typical case where assets were held in India. However, the holding structure was outside, and the condition was being stated that there is no asset transfer happen in India physically. So the jurisdiction has come up and they have changed the legal infrastructure from past also, stating that any asset transfer which is part of India will be taxed, and whatever capital gain other things comes up is applicable. Who has more influence, protector versus trust, in case where there is a conflict between them? See, they both have different roles. Let's look at what the roles are. Trustees are there to hold the assets or take care of assets condition perspective. Protector has a role to instruct the trustees how the assets has to be handled. Now, this is a very important point, as you said, if conflict happens. Now, this conflict conditions has to be clearly articulated in the bylaws of the trust, where you say based on majority, or the trustees can give their discretion and protector has a final authority to take it. Whatever condition you want to put up, you have to articulate that as part of a trust bylaw. So that becomes, as I said, very important document, because whom you want to give more controls? You want to give more controls to protector or a trustee. You can define in the bylaw, but general principle is protector has a more control. Trustee are only having a fiduciary capacity to hold the assets. Yeah, Aditya. Anything else on this side, Aditya, you want to? What you suggest is personal holding family assets outside UAE to have a structure in UAE or Guernsey or BVI. I will just say, as I said in my previous document, and I'm still a firm believer of this point, you should have the holding structure or the trust, whichever you want to create it, in the place where you have controlling people sitting or where you have assets. If you have someone who is part of a UAE family or a Kuwait family, their trust or a holding structure should be in those jurisdictions, unless and until those structures are not available. That's a different point of discussion. But otherwise, first preference is definitely make it the place where your assets or the beneficiaries are sitting, because otherwise you will end up into the legal jargon, or you can say jugglery, where to control, what to control, and how to control. So that's
no. This is hi Rajiv. Hi. This is the main reason why I'm asking this question.
Sure.
Because is it advantageous? Suppose if you have the trust in Jersey, for example,
correct,
is there advantageous or it is not advantageous over having the trust in UAE for the assets outside UAE?
So there are two conditions we are looking at. Who are the trustees or the beneficiaries? Where are they based?
They're based in UAE.
definitely then one of the condition is meeting.
Yes.
Where your assets are.
Now, but the objectives may be different, right? For any family, the objectives may be different when there are assets outside UAE. So in such case, what happens? Whether it is advisable to, what is your advice? Like, what is your views on that? That's exactly my point is.
I'll definitely give you, I need only 2 pointers here. So you gave me 1 pointer. My beneficial owners or my settlers are sitting in UAE. So I have a controlling person which is sitting in UAE. Yes. Now, where are my major assets sitting in?
Outside.
Outside means it's a
outside
taxable location?
Possible, not possible, I don't know.
Okay, we have to look at
both. It's not only for tax reasons. There could be many other reasons, right? It's not only for tax reasons.
Definitely. So let's look at both scenarios. First is, let's imagine if my assets are located in India, which is a tax location. I'm just taking for the benefit of all so that we get into a right decision making in this case. Now my beneficiaries and controlling people are sitting in UAE. From an economic substance regulation perspective, wherever I go, if you remember, we have talked about economic substance has come into all these locations. Jersey is also part of it.
Okay.
So that means I need to ensure that my board meetings, at least once in a year or twice in a year, happens in those locations wherever my holding structure is located. Will I be able to maintain that? Answer may be yes, maybe no, because you may say, I will appoint trustees there and I will keep traveling as a beneficiary or a settler in those locations every year to make substantial activity. Right? Okay. So that means we are getting...
One more thing I want to ask you. In case of law of inheritance, when it comes to inheritance, there are a lot of differences in Sharia law as well as in the other place. Why people do it? Only because of that. There is some advantage, right? Somewhere something more flexible, which is not possible in this. So is there anything which you would like to say on that?
I'll just give an answer here, multiple points. So as I said, the trust structure, which is there in ADGM, which is a foundation structure, does not follow the Sharia law principle. It follows the English law principle and you can adopt that. That's first pointer. So again, I'm saying, look at the jurisdiction. ADGM is one example I can give very upfront. Second
what about DIFC? Any idea?
DIFC is also following the same principle, but they are little expensive on the structure side. Okay. So they are more similar. So both are almost similar, but they have some conditions which add on to some of the pointers. So this is just an example I'm giving. Okay. Second thing, as I said, controlling. So if you can have board meetings in Jersey, perfectly fine. If not, then UAE is becoming a base for you from an India perspective. Okay. Because you can create, now there is a very good condition where the probate can be done for an India document also in UAE.
UAE, okay. Okay.
So these are the benefits which are coming in. But if you tell me your assets are sitting, let's say in Bahamas, my answer may change.
Okay.
Then I will say, then go and create a trust in Bahamas itself because your assets are in the tax-free country. Point number one, the trust law is very good in Bahamas also, and you can execute it very effectively over there. So look at least one condition. Either my controlling people, my shareholders, my stakeholders which are there are based where, and my assets.
Yeah, I know. One more thing, what I would say is, suppose if you register in BVI, for example, although BVI you can register a trust, still, as per the Sharia compliant, the BVI is this thing, so they can attach the assets in the BVI. But there are, for example, Jersey, it's not the case. The Jersey law does not permit that actually. So there are certain, that's why I wanted to have more views on this from you. That's what I was looking
That's perfect. Thanks, Chandrasekharji. I think we have to look at, as I said, multiple things. What the law of the land in which we are trying to set up a trust is coming up. UAE is becoming much more friendly in various aspects. And one thing just to add up, they have brought up the will, which can be an India will, which can be registered from a UAE perspective. And you can have a control from a UAE also.
Okay, that's
great. Rajiv, we have one more question from
Thanks, Rajiv. Thank you very much.
Sure. Thanks,
Sorry, Rajiv, we have one more question. Which law regulate the trust, state law or central law, which you suggest is beneficial?
So which jurisdiction we are talking about? If you talk about from a India perspective?
Yeah, India.
Thanks, Naveen. From an India perspective, if you have registered the trust, so there is a Trust Act which comes applicable. If you have registered the trust, whichever place you have registered, it becomes a part of the legislative document, and it will be applicable across India. So if you have registered in state also and your assets are in various states like Maharashtra, you have assets in Kerala, it's perfectly fine. Your trust document will help you execute. In case of, as I said, whether it's a discretionary or non-discretionary trust, it will get executed. And trust in an Indian parlance from an income tax perspective, it's a legal entity itself and is subject to a taxation.
Rajiv, more precise, I mean, if it is, for example, if a trust is registered in Mumbai, for example, from Maharashtra, so if there is a central law as well, so I mean, which will supersede, because the law in central and Maharashtra may differ. So, and you may have assets in various states as well. So, which law will supersede? I mean, if there is a conflict, that's the question.
Okay, let's take how the distribution of trust will happen. Point number one: if trust itself is an entity and it's a, let's say, a discretionary or non-discretionary trust, that means if something happens to the settler, all the beneficial owners will come and take their rights, right? So if this is a condition, the trust gets converted into a probate. That means you need a government document or a court document to distribute the assets. So once you go to any court, the distribution of assets happen by default to all the assets which you are based into. That legal document you have to take and go to the various locations. Let's say if you have an asset in Mumbai and the trust or a legal document got the right from the Mumbai government, from the Mumbai court, the same document can be used in Delhi land department and the assets will be transferred.
Okay, thanks.
Okay, Rajiv, now I think that's the last question and we can move forward.
Perfect. So I was just giving a perspective here. See, if you see all these locations, these are the famous locations for any trust discussion perspective. We keep talking about either Cayman and Island, you talk about Jersey is the most famous location from a trust perspective. Jersey, Bermuda, Isle of Man, Bahrain. Even Bahrain has a English common law jurisdiction where the holding companies and the structures can be looked at. So we have created a couple of trusts where the holding company comes into Bahrain Financial Center and where the ownership can be moved into various jurisdictions or various entities. So look at when we are looking at the structure. So this is what I was referring to. I'll just go back to my. Perfect. So this is what we are referring to from a trust perspective. So you have two legs of the transaction. One is a trust, which can be in one jurisdiction. My recommendation strongly is create a trust in the place where you have your beneficial owners and the protectors are sitting into, so that you can have a right governance structure, which can be proved and economic substance can be established. Every jurisdiction is asking for these economic substance documents. And if you are not having that proof, even the other tax authorities are eyeing on those information and looking at how we can pick up those benefits. A holding company, again, has to be in the location where you have a major assets or where the major board meetings can be established. And then further is where the location of assets are. So this is where it goes into. But holding company should always look at the jurisdiction which is internationally acclaimed. That means you need to keep sharing the documents or the corporate documents in the various locations. So example, if I create a holding company within the mainland of Kuwait or maybe UAE, it may not have a reference point in India or a reference point in UK. Hence create a jurisdiction which is an English jurisdiction or common law jurisdiction, which can adopt in the various places. I can see some questions here. Let me go back into this. Yes, Chandrasekharji will share the presentation. So definitely this will come back to from a Kuwait chapter side.
Thank you. Thank you so much.
Thank you. So this is what we are talking about. If you look at the holding structures which we talked about, below there is something called REIT. Now, Real Estate Investment Trust or Proprietary Trading Company. So this is again one of the investment types which is predominantly maintained as a wealth management business. Again, this proprietary investment generally can be a passive income generating company or an active income generating company. So if it is a passive income generating company, again, you go back and ring fence into the holding structure, and you provide a very good substance on economic substance regulation perspective, and see how the structure can be looked at. Imagine if this company is a larger company and having a more than approximately 1.3 billion, $800 million of a business. You come into CBCR also, come country by country reporting structure also. Again, taxation is coming into play. Again, your structures are getting ring fenced and looked at from all jurisdiction perspective. And offshore companies are very simple companies where you create an offshore entity, which is dealing with investment in locations where you are not present or where you are not active. So these are some of the models which we have seen how it is working very effectively in the larger business houses. Yes, there are challenges, as I said. Yes, there are infrastructure things which people do. And one more model normally we have seen people are using within their holding companies is special purpose vehicles. I'll give you some examples on how these special purpose vehicles are coming up. Let's imagine this trust is a large trust and having multiple assets. Now, when I say multiple assets, you are having a capacity to buy an aircraft also. And you want to lend this aircraft to a running company, which can be a Kuwait Airlines or Emirates Airlines or whichever airlines. So what people do is they create a special purpose vehicle within the holding company. And the special purpose vehicle is only a leasing arm. So that means you have one side asset and you give a long-term lease to the airline industry and keep getting the rental income on month-on-month basis into your business model. So these are some of the tools which people use. Again, as I said, this is based on what is the size of business, what is the length and breadth of business, because every company creation is a cost. Whether your organization is adopting enough to adopt that cost or not, or how to structure it out. So this is where the things comes into and takes part in. So that's it from my side, Rohit. I'll hand it over back to you for any more questions which are there or any more conversations we have.
Yeah. I think question wise we don't have. One question we have, we can take it up. Is it always beneficial to create trust in tax havens country?
Ankit, not always now, because what has started happening, a lot of countries, I'll say we have to look at where your assets are based. As I said, if your assets are based in, imagine in India, there's a distribution tax or a dividend tax which has come up. So it may not be very effective to do that. If you create a structure, let's say in Germany, in some of the countries, where withholding tax is very limited. So this can be a beneficial. You need to look at where your assets are based. Overall, yes, you need to look at two things. One, whether the common law jurisdiction applies or not. Point number two, what is the tax benefit or tax treaties which are happening between the countries. So if there is a tax treaty and you get a benefit of what taxes you paid in that jurisdiction where assets are held versus where the dividends are being received, it can give you a benefit. So that's, I'll say there is no thumb rule stating that always there is a benefit to have a tax haven countries. If you are not able to control that location, if you don't have economic substance proof, you come back and maybe the countries which are imposing tax will come in and fetch taxes from you through the different means. And that time is coming up very soon, I can tell you.
One more question from Naveen. Similar to SPV companies, are SPV trusts are being recommended? If yes, in which cases?
I'll not use SPV trust, because for trust, I need to have a structure where I can keep the beneficial owners, but they're not the shareholders. But in SPV, you have to define the shareholders very clearly. So you cannot use it, but yes, you can bring SPV below the trust. So let me give a perspective here. If I have a trust, and within that, I want to just take an asset. Let's say you identify a hotel and you want to just take an asset or purchase the hotel for regular rental income. Then you can create a SPV within the trust and you can buy the asset. One condition, as I said, for a trust or a foundation, when we talk, we will have a beneficiaries, which I can create either a discretionary benefit or a non-discretionary benefit. So I'm creating a differentiation between ownership and control. And for a SPV perspective, you need to have a shareholder. So I cannot call a SPV and a trust as in a different way. They both are into a different, you can say, structures. That's what goes into.
Fine. I think we don't.
You are okay with this, or you have some more comments on? I think.
No, I'm okay. I mean, I'm just thinking from the perspective that, since there's a differentiation of discretion and non-discretion, so maybe one could, elect one portion of business under the discretion and another under, a non-discretion. I'm just thinking from that perspective.
You can create within the same trust that you don't need to break it. So as I said, this is part of the bylaws which you are writing from a trust perspective. As I gave example, I can say for the hotel industry, I have a hotel and a manufacturing setup. We can define from a trust perspective that on a hotel, beneficiaries are owners of 2 floors of that hotel. So I define, let's say it's an 8-floor hotel and I have 4 family members. I said everyone is owner for 2 floors. So I'd given a non-discretionary stuff here. Whereas in a manufacturing setup, I say no one can get a benefit of the manufacturing setup because you cannot break that manufacturing setup. You can only get a profit out of it. So you don't need to create multiple trust document. You can create within one also, but how you design that corporate wheel, or you can say how the legal document of the trust can be created is most important thing. So you can create non-discretion in same document. It's possible.
Thanks, Rajiv. So due to a limitation of time, we'll take last question of the day. Any disadvantage of trust from Murtaza?
There are disadvantages we have seen in some cases where trustees are not trusted. So every character is important in the whole game. So let's say if a trustee you create a discretionary trust and the beneficiaries are able to influence the trustees in one direction, you may have a danger on that side. So need to give you that perspective also. So a lot of time we have seen it's always good to have professional trustees. And we have seen that role. I'm not talking about, I'm not saying that lawyers are not right, but we have seen a lot of banks are taking that role very effectively. But the only challenge with the banks is banks are not ready to go for anything which is non-financial assets. So they say you create a wealth, you do deposits, you do stock market and everything. We can create a trust out of that. But if you ring manufacturing companies and all, we can't control them. So that's a drawback. You can say we need to be very careful how the trustees are defined and how powers you give to the trustees. That's also very important. So every character has a very important role in the trust formation.
Yeah. Thanks, Rajiv. It was very informative. So I'll hand over the floor to CA Umesh Soni for a vote of thanks. Umesh, over to you.
Hi, Rohit. Thank you. Thank you for handing over the proceeds to end the session. So thanks, CA Rajiv, for having this session with us and enlightening us with the topic of family office structure. I think after this session, the audience would be having the idea on whether to have a trust or a holding combination in the corporate world. However, I would like to add on a personal point of view that a perfect family is the one which has the trust as well as the hold together during the tough time. So that's the more important thing in our personal life. So thank you for giving the technical knowledge to us. And I would like to thank the ICAI Kuwait chapter members for attending this meeting and making it interactive, because interaction is more important and gives more information to everyone who is attending the meeting. Thank you. Thank you, everyone.
Yeah, just before we leave, if we can switch on the cameras so that I can take a picture of today's session. If everybody can switch on their cameras.
I love Ajayji's portrait, so it's
yeah.
Yeah, so I'll just take, so 1, 2, 3, cheers. Yeah. So one more. 1, 2, 3, cheers. Yes, I have taken it.
Thank you, Rohit.
So wish
Thank you, Rajiv.
Thanks, Rajiv.
Thank you.
Thank you very much.
We'll be in touch, Rajiv. Lots. Sure.
Thanks to everyone for organizing.
Thanks.
Thank you, everyone. Chandrasekhar ji, a special thanks to you for joining in.
Thank you. Thank you.
Yeah.
Thank you so much. So with all your permission, I am just ending this meeting now.
Yeah. Sure. Thank you.